Hi everyone and welcome to 3 Charts in 1 with me, Richard Perry, market analyst for Infinox on Friday the 9th of December. Now there's been a slight rolling over of treasury yields and that's helped to drag the dollar back and improve market sentiment slightly, and we can see that through these charts that we're looking out for today. We've got the dollar yen chart, we're looking at the gold price and the German DAX. So straight into it with this dollar yen chart. This is a chart that is very much a function of how the treasury yields move, and treasury yields had rebounded and are now rolling over, and we're seeing very strong positive correlation with dollar yen still playing out as the yen starts to strengthen again against the dollar, and we can see that still within this downtrend. The move that rebounded back into this resistance area, I'll go out one more level, you can see the importance of it. These old lows and old highs, this resistance area 137.50 up towards 139.40 area, big resistance. We've got the 21-day moving average, we've got the downtrend. All of this old support becomes new resistance. We saw that a couple of weeks ago, and we can see it playing out again as the market just rolls over. The RSI has just unwound back from below 30 to now around that 40 level, and is just sort of rolling over again. This bull failure seems to be playing out. Now we've got the US CPI inflation next Tuesday and the FOMC on Wednesday, so very much volatility that we can expect for next week. But certainly I think having sort of rolled over here, if this now is the drive lower, which I think it could be, on the assumption that CPI inflation isn't much bigger than expected, and the FOMC isn't more hawkish than markets have been pricing. If it's a fairly standard, if the expectations are hit, then I think we're going to see the dollar weakening and then dollar yen moving lower again towards this 131 to 132 area of support that we had back in July. And I think it's likely to be continuing to play out within this downtrend. So let's just zoom in one more level, and we can see that here we've got the resistance coming in overhead. The key resistance, I suppose, would be this reaction high here, which was 139.89, 139.90. So basically above 140 big figure would be the turnaround moment. That would be the market starting to pull higher. It would be turning bullish if you saw it moving above 142.25. But certainly for now, we're still playing out lower highs, lower lows, selling into strength, in my opinion, here. Moving on to the gold price, well, we've seen this recovery in gold. Let's go out one more level. We can see this recovery, the base pattern here that completed above 1735, pulled back to the neckline, found support, moved higher again, is testing the next key level of resistance. 1808 was that reaction high back in early August. 1810 before this week, when we saw the big bearish engulfing candle. The market didn't really go lower on that, and it's actually now started to form this uptrend again, ticking higher in recent days, looking positive still configuration on the RSI momentum. So still buying into weakness, still playing within this rising 21-day moving average as a basis of support as well. And it looks like it's going to be testing that resistance again, 1810. Now, again, US CPI, important. If it comes in higher than expected, that means a more hawkish Fed, and that would mean a strengthening dollar, and that means yields moving higher. That would mean gold moving lower. Whew. Anyway, so that's next week, but at the moment it looks like it's moving towards a test of 1810. That is the resistance. Breaking out of that, you've got the base pattern implied target of 1844. And what we see is the market still posting these higher lows. So that reaction low of 1765 is the initial one, that reaction low that we saw on Monday. That's actually a nice little pull back into support there. As I said, that rising 21-day moving average. The key reaction, though, obviously is the 1728 actually, but 1735, 1730 was the breakout of the neckline. 1728 was the reaction low, as you see these supports. So a few levels there, but certainly it looks still positive in front of this US inflation data. And finally, moving on to the DAX. Equity markets have had this strong run higher, but the uptrend has been broken. We've seen that on Wall Street. We've seen that through the European markets as well. And we go out one more level, we can, well, two levels actually, before we start to see the importance of this resistance overhead we've got here on the DAX. 14.7 to 14.8, old key lows, old reaction and reaction highs. seriously important resistance overhead, and the market is just tailing off underneath that. Now the question is, how far does this reaction go? Well, my thinking is that 14,125 is this old reaction low. If you see them break underneath there, you do start to see a deeper correction, but I don't think it's going to be a correction that goes especially far. If this is a bullish outlook, still is a recovery play on the DAX on a medium-term basis, then you'd see the support coming in 13.6 up towards 13.9, 14,000. That is a key support area on the DAX. You may see, as I said, if 14,125 gets broken, we see that rolling back into that support area, but that would be the key test going forward then. So how does the market react around that 14,125 is important. And obviously the overhead resistance 14, well, I mean, the reaction high is 14,604, but 14,700 is where the big resistance starts to come in. So I wish you good luck in your trading, and I'll speak to you next week.